In this class, we're going to be concerned with organizational growth, and in particular, diversification. And we want to start by looking at diversification strategies, or at least introduce diversification strategies and talk about them in more detail later in this session. So to start, a corporate strategy in which a firm expands its operation by moving into a different industry. That's what we mean by diversification. Diversification is when a company develops a strategy which means it moves into, it tries to form relationships with companies in other sectors, or actually opens a business in a different sector, a different part of the market, perhaps with a different technology, with a different output, or it could be something related. But the point is, it's moving out from its own business and into a different area. It could be a related area, or it could be a non-related area. There are many reasons or motives for diversification. Two major types of diversification that we'll come across are known as concentric diversification. Now this means the diversification is related, that a company in a given sector forms a relationship, a commercial relationship with a company in a different sector, but they have perhaps something in common. They may have marketing, or the use of a certain technology, or distribution channels, or they have something related. So it's concentric diversification. In this case, one business is joining perhaps with another business, or indeed opening its own business, opening a totally new business, but in a related field. It's related to what it's doing at the moment. So there is a connection between its current activities and what it's proposing to do, which is form a commercial relationship with a company in a different area, but related. Or it could be itself opening a new business in a different area, but still related to what it's doing now. So working in perhaps the same sector. The second type of diversification is known as conglomerate diversification. This is when the companies are unrelated. So a company in one sector forms a commercial relationship with a company in a different sector, but really they've got nothing in common. They don't have a lot in common. The reason for this is although I say they don't have a lot in common, they may have some particular parts in common. They may share the technology. They may share distribution. There may be some element between them that they're able to share, but sometimes they don't. It's just a company wants to open a different company in a different market entirely. It just wants to diversify completely. It started in engineering and now it wants to move into services. So it could do. That is conglomerate diversification, two completely separate businesses, but owned by the same group of shareholders. It could be, as I said also, that they may have some small elements in common. It could be a company opens a business in a different area and it looks completely different, but they may share distribution, or they may share something. So we have different ways of looking at conglomerate. Conglomerate could be totally disconnected, or there may be some small element of connection. But essentially it's a big move from one sector into a different sector. Whereas concentric, there is a connection between the two parts. So why do firms diversify? Well, to grow is an immediate answer. There are several reasons, but to grow is certainly important. It's an effort to increase its sales and its profitability beyond the firm's core businesses. So it's trying to look at what it does right now. What's the product? What does it make? How does it sell it? What are its markets? And so on. And is it possible now to increase its sales and its profitability by having a relationship with another company in a different sector? Is it possible even to diversify and open a totally new business in a different area and thereby grow its sales, albeit of totally different products? But is it possible to grow sales in this way and increase its profitability? So I suppose in a sense this is a company that is run by entrepreneurs. These people are constantly on the lookout for profit opportunities to see if there's some way of expanding or diversifying to try and generate extra profit. Sometimes diversification may be driven by managerial desire to assert itself. The managers want to be in control of a large business. They want to show that they are dynamic and they want to project themselves. And in this way, there's a drive to grow the business. This is also could be related to this idea of hubris, the idea that the management is proud to be associated with a large business. So it's managerial self-serving behavior. You know, the managers want a growing business because their remuneration, their salaries is linked to the performance of the business. So they want to have a successful business because that means they get more salary. Or it could also be simply in the status. Managers want to be seen to be managing large businesses, not small businesses. It could be also that the drive to grow is related to utilizing the existing resources and skills that the business currently has. So current businesses may have built up an expertise in marketing or in budgeting or in some sort of technology or some sort of design. So the current business has got strengths and it needs now to fully capitalize on those strengths, and to do that it might need to grow. It might need to have a separate business, it could be related business, in which those skills will fit in and be used there. So why do firms diversify? Well, to reduce risk. That's one good reason why firms diversify. I said earlier to grow. That could be a major reason, but also to reduce risk. That could be an issue. Companies who make a single product or a limited number of products, they have the fear that the market may turn against them, that consumers' tastes may change, and that in a short space of time they won't be able to sell. So they want to reduce the risk by diversifying into different products. So if one line of production is affected by a change in customer tastes, adversely affected by customers' tastes, then the second line of production will continue and the business would continue. So it's trying to reduce the risk. It could be trying to escape from unattractive or undesirable industries. Seems like a strange proposition to put forward, but sometimes businesses do become undesirable. Businesses that rely heavily on energy consumption or on the production of a lot of waste, which may get a bad press and may turn the population, the people, against that type of product and that type of company. The company is not seen as a nice company. So there is a desire to get out of that line of production. But risk reduction could also lead to some sort of stability in profit flows. We have systematic and unsystematic risks. Shareholders and diversified portfolios. We have issues here about trying to to bring greater stability into the profit flows. The company's making a profit. That's why companies exist. The companies exist to make a profit. They don't exist for our welfare necessarily. Perhaps some do, but the vast majority, it's suggested, exist to make a profit. But if the profits are highly variable because customers are perhaps changing away from it because tastes are changing, or the demand is highly seasonal or whatever, perhaps the business wants to utilize its resources more evenly over the year. So it may want to spread the risk by opening a second line of production, opening a separate business. Could also be the case, of course, that the business has too much cash flow. The business is successful. It may have large balances. And large balances, if it's a public company, then it may leave itself vulnerable to a takeover. People may try to buy the shares, and buying the shares to try and get their hands on the surplus cash. So in order to use the surplus cash, if a business has got surplus cash, it may decide to open a second business. So it may use the cash balances to avoid hostile takeovers. It may use its strength to try and fight off the takeovers. It may also build shareholder value, create synergy amongst businesses of a firm. Sometimes if a company is making a particular product, it's able to make some other product that is very closely related, perhaps in technology or in the use of machinery. And perhaps if some machinery was standing idle some of the time in one of the business, that machinery can now be brought into production to make items for the second business. In this way, the synergy, the fitting together of the two businesses to make a more complete single business. So the two businesses are starting to support each other very closely. Production is starting to link, and distribution could be linked. Instead of running lorries half empty, the lorries could now run full because two businesses are cooperating. So diversifying can lead to that sort of economy, that sort of saving. It's sometimes summarized as 2 + 2 = 5, which of course doesn't make a lot of sense arithmetically. But 2 + 2 = 5 means sometimes when two companies come together, the two companies, when they join forces, they don't double their output. They get a bit more. They're able to work out greater efficiencies. And there are economies in the size of the two companies, economies in the size of the departments that are cooperating perhaps. So the whole should be greater than the sum of the parts. The combined efforts of the two companies working together, that should make greater efficiency. So 2 + 2 = 5. In other words, the two companies, by coming together, they don't double their output, they get a bit more because they're able to work out efficiencies and capitalize on those efficiencies. Synergy, this idea of synergy, can be obtained in three ways. First of all, economies of scale, economies due to size. Economies of scale are economies of size. Larger companies are able to negotiate discounts on bulk purchasing. Larger companies have better distribution networks. Larger companies are able to better afford services such as the accountancy department, or specialist software can be brought in to increase production. There are many economies of scale, and that's the subject of a separate video on this course. But there are many economies of scale that we can envisage. And synergy can be derived from economies of scale. This idea of fitting the two companies together, or fitting many companies together, the combined output is much greater than it would have been had they all acted individually. Economies of scope, that's the range of the company. It's what the company can do, its product range, and its penetration into markets. So some companies will have expert knowledge of markets, of particular markets. They'll have expert knowledge of particular geographic areas and perhaps of different countries. So by coming together, there's a knowledge sharing as well as the economies of scale. They're able to share knowledge and expertise. They're able to work out efficient designs, and they're able to tailor the products to the cultures they're selling into, to the types of customers they're expecting to get. Efficient allocation of capital through the use of portfolio management techniques. Well, capital is expensive, and it's also capable of lying idle if it's not used efficiently, if it's not properly configured. So when several companies agree to collaborate, then they're able to work out a good configuration for capital so that the machines are running to an optimum. They're running all the time, in effect. They're not standing idle for some of the time, and there's no expensive retooling, or the production can flow smoothly through the system. So it's working out the portfolio of management techniques that are suitable for that type of production and that type of business. The portfolio of management techniques could be an efficient office with an account section and a marketing section, and with planning and with design and so on, research and development. And these overheads can now be shared out and allocated more efficiently. So one company does not carry the burden of all of those overheads. The whole management portfolio can be shared, and there is an efficient production underpinning it. Problems that prevent diversified firms from realizing synergies. Well, poor understanding of how diversification activities will fit or be coordinated with existing businesses. Sometimes it's difficult to see how businesses can cooperate. It may be they're making products which are totally different, which means it's very difficult to see how they're going to share resources or share capital, share distribution. So there may be issues along those lines. But even then, if we take the point previously, the point C just above, it still may be possible for the companies to share the management portfolio, share the costs of management. It may be possible to have an account section which is able to work efficiently for both companies, is able to use specialist software, and the people working within the account section are specially trained to use the software, and it fits both companies. So even though there are issues about how well businesses can fit together and how well management understands the degree to which businesses can fit together, there are still functions that could still be considered, such as the management one I mentioned above in point C. Danger or risks associated with the acquisition of a business. Well, there are always dangers, obviously, in the acquisition of a business. Sometimes if the business is easy to acquire, it means there is something wrong. The shareholders might be only too happy to get out, sell off their share and leave. But why would they want to do that? Is there something wrong with the business? Is there information in the background that's not obvious to the buyer? Is the market turning, or will there be new legislation from the government which will affect the business? So there are dangers associated with the acquisition of a business. And there are also problems with the development of internal businesses, which means sometimes if a company diversifies within its own premises, so really there are two businesses running under the same roof, then there could be issues, HR issues, for example, amongst the line management. A disconnection between the line management. They may not agree about everything, or they may not cooperate. They may not facilitate the two businesses very smoothly. There may be somewhat artificial lines drawn between the workers and the management for the two businesses. So there are issues about synergies when looking into diversification. Diversification is capable of increasing shareholder value if it passes three tests. First of all, the attractiveness test. The industry must be structurally attractive or capable of being made attractive. So shareholder value will increase if the industry is seen as attractive. The industry has to be seen as one that's increasing in value. The status of the industry within the market is increasing. Customers like the product. It's using a clean technology. It's got a good image in the marketplace. If all of these things fit together, the shareholder value will increase. There's also the cost of entry test. The cost of entry must not capitalize all future profits. I suppose it goes without saying that all future profits should not be used up. The anticipation of all future profits must not be used up in trying to acquire a business. The whole idea of acquiring the business is to generate future profits. That means more is coming back to the shareholders. Acquiring a business and then using all of the future profit stream to pay off for the purchase of the business flies in the face of the exercise. It goes against the whole rationale for the exercise. There's no point in buying the business if all the future profits of that business will be used in paying off for the money spent on acquiring the business. So it's important that the business makes a net profit for the shareholders. The better off test. Either the new unit must gain competitive advantage from its link with the corporation or vice versa. There must be synergy. So it must be the case that if a business acquires another business, it must be the case that there's going to be net advantage. And the net advantage can come about through greater competitive advantage in the market, so that competitors suffer and competitors lose market share, and there's more profit coming to the business because the business is now bigger. It's acquired a new business itself, and there's more synergy within the business, so that the competitors are finding it difficult. But there must be net advantage. That's the point. The whole reason why the diversification took place was so that the business would be better off. Now, concentric diversification. Diversifying into a different industry, but one that's related in some ways to the organization's current operations. So this is where the two companies have got links. They've got something in common. It could be the technology, the production, it could be the product design. They've got something in common. And the search for synergy, which is the performance of the sum of the parts, which is better than the whole, the 2 plus 2 plus 5 equals 5 that I talked about earlier. The idea of concentric diversification is trying to search out that synergy, search out the advantage, search out the ways in which the two businesses can be slotted together to generate extra savings and cut costs, produce more, have a greater presence in the market, a better reputation in the market. So if that's to happen, the two companies should ideally look critically at each other's operations before any diversification takes place, and try to highlight where synergy can be identified. Identify it, and if it's significant, then the diversification should take place. Synergy happens because of the interactions and the interrelatedness of the combined operations and the sharing of resources, capability, and distinctive competencies. So that's where synergy comes from. It comes from the distinctive competencies of the workers and of the business, the things that the business can do best, its capabilities, its use of resources, the way it's configured, and the way that, because it's configured in a certain way, it's able to fit closely with the one that it's now diversifying into, the related business that it's linking to. So the two companies are able to fit snugly together to generate savings, to generate extra profits. Related diversification, well, build shareholder value by capturing cross-business strategic fits. As I said, look for areas where the two businesses can fit together smoothly. The more the two businesses can fit together, the greater the opportunities for synergy, the greater the opportunities for cost saving, and hence more profits. So look to areas where they can fit together. It could be in distribution, production, research and development, in services, in whatever. Look carefully for the strategic fits. Transferring skills and capabilities from one business to another. It could be that the two businesses are slightly different in their approach to, let's say, production, but perhaps one of the businesses has a better track record in production. It's more efficient. It's more capable of producing the output at a lower cost. If that's the case, then those skills could be transferred across to the new business, which would make the diversification even more profitable. So transferring skills between the two organizations is a good idea because it will generate the extra profit. Sharing facilities or resources to reduce costs. Well, insofar as we're talking about diversification and related diversification, I suppose it goes without saying that there will be sharing facilities. But the idea of sharing facilities or resources to reduce costs is one of the driving forces in the whole diversification exercise. The whole idea is to reduce costs. So sharing facilities comes naturally out of that. It could be sharing transport or logistics, or it could be sharing the stores. It could be sharing production on certain lines of production, or sharing research and development, because the research and development department perhaps have a strong history of innovation in one of the businesses and weak in the other. So sharing it means a better outcome for the combined business. And using the common brand name, using the brand name, because if one of them has a strong brand name, then build on it, because now the business is bigger and has more capability in the market and will be seen as bigger and better. So leverage, use the common brand name. Combining resources to create new competitive strengths and capabilities. Again, that's one of the driving forces, to outdo the competitors. By merging, by diversifying and growing together, the two businesses already have lost one competitor because one of them is now cooperating with the other. So one competitor less in the market straight away. The ones that are left should be at a disadvantage. They haven't got the same knowledge base, they haven't got the same synergy, they haven't got the same ways of cutting costs as the two who have joined. So using the new competitive strengths and capabilities to exert power in the market. Advantages or benefits of related diversification. Opportunities to achieve economies of scale and scope through skill transfers, lower costs, common brand name, technology, etc. That's what we've been going across in the last couple of slides. But to identify it as a set of advantages. So related diversification leads to these sort of benefits. Economies of scale, economies of scope, sharing knowledge, sharing skills, sharing technology, and sharing distribution, and so on. Opportunities to expand the product or service offering and preserve unity in the business. So there are opportunities to bring in new products. New product development won't be as expensive in a sense because it'll now be shared. It'll be shared by a bigger organization. So the bigger organization will be able to afford research and development a little more easily. It will be able to expand its service, perhaps open different outlets and enter new markets. The disadvantages, well, it's the complexity and difficulty of coordinating different but related businesses. And there are many examples that we can find in the literature. Sometimes when companies diversify, many years later they have to undo it because it's complex. It's not just the complexity of trying to bring the two businesses together and coordinate the two businesses. It's also the complexity of getting the HR situation sorted. There are different cultures in both companies, and trying to get them to sign up to a single identity may be difficult. And it's never as simple as just slotting the two together. There are mismatches that need to be worked out. Sharing the stores facility may not be possible because of geographic location. Distribution may not be that smooth because the types of transport that are required for one business is different from the other. It's complex. So there are issues that go against this. So related diversification is strategy-driven approach to creating shareholder value. That's the idea. If it all works, the whole reason why we're talking about it is because it is strategy-driven, and the idea is to increase shareholder value. Unrelated diversification, well, diversifying into completely different industries from the firm's current operations. Totally different industries. Diversifying into different areas. So it moves into industries where there is no strategic fit to be exploited. The companies are different. They're different and there's no obvious fit. They don't smoothly fit together. They don't link together that well. They're in different sectors, making different products, different technologies, and so on. So there's no obvious strategic fit. No meaningful value chain relationships. So they're not linked through the value chain. Which means the businesses, a bit like number one, just above it, they don't fit together. There's very little opportunities for synergy. There's very little opportunities for obvious savings. And there may be no unifying strategic theme. The businesses may be pointing in different directions, trying to do different things. So they're unrelated. The approach is venture into any business with good profitability prospects. So the idea here is that the businesses don't join up because they can see advantages in joining up through their production or through sharing facilities. Instead of that, they are simply looking for profit opportunities anywhere with any product. As I said much earlier in this talk, it's as if the managers and the owners of these businesses are entrepreneurial in the extreme. They're just looking around for profitable opportunities. They want to use their resources to acquire businesses in any sector that's profitable. So they don't have to be related businesses. They can be just any sector that's profitable. Targets for unrelated diversification. Well, firms with undervalued assets. Sometimes when we look at the ordinary shares of the business, the number that's been issued, and we take the market value on the day, multiply it by the number that's issued, and then look at the value of the business, perhaps looking at the capital, the reserves of the business, and so on, the business is undervalued. So a company might try to buy up another company. They're getting something on the cheap. They're buying the company that's cheap. The resources of the business, the capital of the business is more than the market value of the business. Sometimes companies are in financial distress. Sometimes companies have cash flow problems or various issues that leads to financial problems, in which case the companies may be acquired cheaply as well, and some companies will buy them up even though they're in a totally different area. They're not related to what they're doing. Their core activities might be in engineering, and we're talking here about acquiring a business in fashion or in building, different areas. They're trying to look for companies with bright growth prospects but limited capital. They're trying to look for companies cheaply, but companies that will grow and have opportunities to grow and have potential to grow. So, as I said, these are very entrepreneurial moves. The company and the owners and the managers of the companies are entrepreneurial. They want to take on the challenge of a new business in a new sector, a company that's perhaps undervalued at the moment but has good market potential. The advantages, well, business risks are spread over different industries. So to the business, it's a good idea. It now has two businesses, but they're not related. One's in perhaps building and the other's in engineering. But risks are spread. If the building industry one starts to decline, the engineering one may hold up. So risks have been spread as a consequence. It may be there is a more efficient allocation of resources. It may be that the company puts its revenues, its spare revenues, into the new business where they make a bigger return. So there's a better allocation of capital resources. If the acquiring company has excess cash, a good cash flow situation, it's got excess cash, by putting the excess cash into the other business will start to grow and perhaps they'll get a higher rate of return on their investment. There may be stability of profits. As I said, if one company dips, the market in one area dips, the other one may hold up. So the profit overall may not be significantly affected. There's more stability because they're operating in different markets, different companies in different markets. The shareholders will benefit from this, of course. Greater stability in profits means perhaps more security in dividends, and the shareholders will be rewarded for holding their shares in the company. Disadvantages. Well, difficult for competing, for competently managing many diverse businesses. The competency of the managers, their ability to manage, may be related to the type of business they're in. Some people have a particular aptitude in working in engineering or working in the building trade or whatever. But they don't transfer across, so there might be difficulties in managing the two businesses. So it may be the case that it only happens at the higher levels. There may be no strategic fit which can be leveraged into competitive advantage. The two businesses are unrelated, so there's no obvious linkage between them, so they can't be used for any competitive advantage. There are competitors, let's say, in the building trade, and there are competitors in the engineering trade. Well, the competitors in the engineering trade are not affected by the competitors in the building trade, so there's no strategic fit. There's no obvious competitive advantage for the business in acquiring a business in the other sector. They are so different, so there's no competitive advantage. Unrelated diversification is finance driven. It's unrelated diversification is trying to acquire a business that is in trouble perhaps, or it has some sort of issue, some problem, bringing it back from the brink, but its assets and its resources exceed its market value, so it's acquired cheaply, and by running the business they're able to diversify their own portfolio into two sectors, perhaps, as I keep saying, perhaps in, I don't know, engineering and building, or engineering and fashion, or whatever it is. So they are running two businesses, and in that way they are diversified. If one of the businesses is badly affected by some change in the market, the other business will hold up, chances are. So there's greater stability in profits, and the shareholders will like the stability in profits. But the disadvantage is, of course, it's complex, it's difficult to manage, and it's difficult to get the type of management at the upper levels who are capable of taking on two completely distinctive businesses and running them. So that's diversification, or some ideas on diversification which we need to be aware of, and that's all I'm going to do in this session. So I'm going to leave it at that and say thank you for watching.